Recently, we've been on a bit of a run when it comes to Vanguard Global Equity Funds, so why stop there? In today's video, we're going to talk through the Vanguard LifeStrategy 100 fund. We're going to describe exactly what it is, and then we're going to see how it stacks up against the other global equity trackers. If you're a UK-based Vanguard investor, then you should consider joining the Vanguard Investors UK group on Facebook. It's an active group, and there's plenty of discussion and advice on there on all things Vanguard. In this group, I see that plenty of people are actually invested in the Vanguard LifeStrategy 100 fund. Some people are happy with their investment, and some want to move over to other funds. In fact, the fund holds around 2.3 billion in share class assets, so it's a pretty popular option. But just because something is popular, it doesn't mean that it's the best. So, in today's video, we're going to analyse this fund in detail, and then we're going to see how it stacks up against the FTSE Global All Cap Index Fund and VWRL. Let's get into it. There is no doubt that the Vanguard LifeStrategy funds are a great range of investment options. It includes the Vanguard LifeStrategy 20, 40, 60, 80 and 100 funds. The number in the title refers to how much of a fund is invested in equities, with the rest being invested in bonds. This means that you can easily select a fund based on your investment horizon and risk tolerance. If you're a cautious investor or have a short investment horizon, then perhaps you could consider investing in one of the funds that has more bonds, such as the LifeStrategy 20 and 40 funds. These funds will generally be less volatile, but you also have lower expected returns. Alternatively, if you're an investor who has more of an appetite for risk, or perhaps have a longer investment horizon, then you could consider holding one of the funds that holds more stocks, such as the LifeStrategy 60 or 80 funds. Then there is the final option, the LifeStrategy 100 fund. You're willing to take the maximum level of risk that you can. 100% equities. Market volatility doesn't scare you at all. You're going to hold strong through thick and thin. In fact, nothing can scare you. You live life on the edge. Not only that, but you've got years ahead of you to build your portfolio. A market drop now would just be a temporary bump in the road. Fast cars, drum and bass, 100% equities. Full throttle, one gear, go. But wait a minute, are you sure this is the right choice? No, I'm not talking about your risk tolerance or investment horizon. Maybe 100% equities is right for you. But just because you want to invest in 100% equities doesn't mean that you have to invest in the Vanguard LifeStrategy 100 fund. There are other global funds out there. But before we go into this in a bit more detail, let's first analyse the LifeStrategy 100 fund. To learn about this fund, we're going to go to Vanguard's UK website. From the homepage, click what we offer, then LifeStrategy funds. Then scroll down a little and you'll find the LifeStrategy 100% fund. Click on it to learn more about it. Here, you are taken to the overview page, where you can learn some basic information about the fund. The key stats on this page are the asset allocation, which of course is 100% equities. Then the ongoing charge, which is a respectable 0.22%. Then there are a few paragraphs describing the objectives of the fund. The key points here are that the fund invests more than 90% of its assets in Vanguard passive funds that track indexes. It then says that the fund is actively managed in that the investment advisor has discretion in respect of the associated schemes in which the fund may invest and the allocations to them, each of which may change over time. Now, before us passive investors run for the hills, let me first explain what this means. The funds within the LifeStrategy 100 fund are passively managed, but a manager has to select those funds, which in a sense is an active decision. This is the same as you investing in a range of ETFs or index funds to make up your own portfolio. The ETFs and index funds may not be actually active, but you selecting those funds is an active decision. It then goes on to explain that the fund invests in UK and non-UK companies, including the emerging markets. This basically means that it's a global fund. To learn more about the holdings of the fund, you can click on the Portfolio Data tab. This section is a little less detailed when compared to other funds on Vanguard's UK platform, but it still shows a percentage allocation of each of the funds that are held within the LifeStrategy 100 fund. If you do want to learn more about the individual funds, then you can just find them on the website and analyse them individually. But at a glance, you can see that you get access to the US markets, UK markets, developed markets, emerging markets, and there are also some Pacific-based funds too. The weightings allocated to each country is not immediately obvious, as the US, for example, is included in the US Equity Index Fund, the Developed World excluding UK Fund, and the S&P 500 ETF. But to give you an idea of the allocations, we're going to look at the weightings associated with the US and the UK, and then we'll compare it to a global index. We're going to use the FTSE Global All Cap Index as reference, as it is considered to track the global markets well. For the LifeStrategy 100 fund, the US allocation, which stems from 3 different funds that we just discussed, is around 45.6%. This can be compared to the FTSE Global All Cap Index, which has a US allocation of around 56.5%. Then, for the LifeStrategy 100 fund, the UK allocation, which stems from the UK All Share Index Unit Trust, the FTSE 100 ETF, and the FTSE 250 ETF, is currently 25%. This can be compared to the FTSE Global All Cap Index, which has a UK allocation of 4.1%. So, when compared to a global index, the LifeStrategy 100 fund has an 11% under allocation to the US and a whopping 21% over allocation to the UK. So clearly, it doesn't match up to a global equity tracker, which is important to consider. As you are essentially overexposed to the UK, your returns are going to be more dependent on the performance of the UK markets. Of course, if the UK performs well, this could be a good thing. You could receive higher returns. Alternatively, if the UK performs poorly, this would be a bad thing, as you'd receive lower returns. But do remember that trying to guess whether the UK will outperform the global markets over a set time period is essentially trying to time the market. And, as we all know, trying to time the market is generally a fool's game. So, if you're investing in the LifeStrategy 100 fund just because you think the UK will outperform over the next few years, then just remember that you're fighting against the market forces which have been proven to be hard to beat. In reality though, the LifeStrategy 100 fund is likely overweight in the UK because the UK markets are cheap for us to access, so it keeps costs low. Also, when the Vanguard LifeStrategy funds were launched back in 1994, global diversification wasn't quite as big as a deal as it is now. It was very common to see funds like these have a huge bias towards their home countries. So, does this mean that the LifeStrategy funds are a little outdated? More on that in a moment. But before we look at that, let's take a look at the distributions page. The fund is naturally accumulating, meaning that the dividends are automatically reinvested to boost the growth of the fund. But if you want your dividends to be paid out, you can switch to the income share class. By doing this, you'll receive a yearly dividend payment. The dividend yield is currently 1.98%. On the final tab, you can see the cost and minimums. Here, you can see that the ongoing charge for the fund is 0.22%. If you look on the Vanguard full costs and charges document that I'll link in the description, you can see that the fund also has a 0.02% fee for transaction costs. These are the costs associated with Vanguard buying and selling shares that make up the fund. They're automatically deducted from the returns that you receive. Finally, as with any other Vanguard fund, there is a minimum initial investment of a £500 lump sum or a £100 monthly direct debit. Just remember that if you've already invested in funds on your Vanguard account, then these minimums no longer exist. So that's an overview of a Vanguard LifeStrategy 100 fund. But now, into the good stuff. Should you actually invest in it? Well, to help us answer this question, let's take a step back. What are the Vanguard LifeStrategy funds, and why are they so good? Well, if you want the details, we've got a whole video on this, which I'll make sure to link above. But in summary, they are a type of fund that allow you to invest in a set allocation of stocks and bonds all in one fund. This means that you could invest in just one fund and have a portfolio that will match your risk tolerance and investment horizon. If you want less risk or you have a shorter investment horizon, select a LifeStrategy fund that holds less stocks and more bonds. Or if you want more risk or you have a longer investment horizon, select a LifeStrategy fund that has more stocks or less bonds. The beauty of it is that it's simple. All of your equities and all of your bonds in one fund. You don't even have to worry about rebalancing your portfolio. But if you're investing in a LifeStrategy 100 fund, you're not actually investing in bonds. You're just investing in 100% equities. So if you want 100% equities, why select the LifeStrategy 100 fund? Why not select another globally diversified fund, like VWRL, the FTSE All World ETF, or the FTSE Global All Cap Index Fund? Now don't get me wrong, I understand why the LifeStrategy 100 fund exists. There is the LifeStrategy 20, 40, 60 and 80 fund. So it just makes sense to have a 100 fund for those wanting to go for 100% equities. But inherently, the LifeStrategy 100 fund is just a 100% equity fund, like the other funds that we just discussed. So to help us decide how it stacks up against those other options, let's first look at the diversification aspect of it. As we mentioned before, the LS100 fund invests in a range of index funds and ETFs that cover the global markets, which is great. However, the percentage allocation for each country does not match up to the FTSE Global All Cap Index. The allocations of the FTSE Global All Cap Index are market capitalisation weighted. This means that the countries with the largest total stock market values have more allocated to them, as they make up a larger proportion of the global markets. The majority of indices calculate their allocations using this method. Of course, it makes sense that the US gets more allocated to it than, let's say, the Philippines, because the US economy is much larger, and it has a much larger total value when compared to the Philippines, which will only be small. As we mentioned before, the LifeStrategy 100 fund includes an under-allocation to the US and a massive over-allocation to the UK. VWRL and the FTSE Global All Cap Index Fund both track indices that are market capitalization weighted. So, their allocations are almost identical to their underlying indices. This means that the funds are much more representative of the global markets. So, which is best? Well, it's down to opinion. And we'd just like to remind you that our opinion is not a professional one. We're just two guys on the internet making finance videos for fun. But, in our completely unprofessional opinion, we think that VWRL and the FTSE Global All Cap Index Fund do it better. By being more representative of the global markets, they are accurately attaining the returns that the global markets produce. The LifeStrategy 100 fund is about 6 times overweighted in the UK, which is quite considerable. Also, despite the UK markets being cheaper to access for UK investors, the ongoing charge at 0.22% is the same as VWRL, and it's only 0.01% less than the FTSE Global All Cap Index Fund. Now yes, you could make the argument that the UK markets are undervalued right now, but in our opinion, that doesn't mean that you should invest more into the UK markets. By doing this, you're essentially trying to time the market, and research has proven that attempting to time the market often results in lower returns. But let's say we can't talk you out of it. You're certain that the UK will outperform the global markets over the next few years, and you want to allocate around 25% of your portfolio to the UK. Well, in that case, take a look at this 2-fund portfolio that we put together. If you allocate 80% to the FTSE Global All Cap Index Fund and 20% to the FTSE UK All Share Index Unit Trust, you get a globally diversified portfolio that has a 23.3% allocation to the UK. On top of that, you get the added bonus of a lower ongoing charge at 0.196%. due to the cheaper access to the UK markets. This turns out to be cheaper than the LifeStrategy 100 fund, which has an ongoing charge of 0.22%. But do remember that we don't advocate an over-allocation to the UK, and you should also do your own research before investing in this portfolio for yourself. In fact, in our unprofessional opinion, as a 100% equity investor, you'd be much better off investing in VWRL or the FTSE Global All Cap Index Fund. Yes, the Vanguard LifeStrategy 100 fund is a good fund. It's cheap and well diversified. But if you want the hardcore 100% equities lifestyle, make sure you're in the best vehicle.